Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
All right, now before we get rolling, I want to ask everybody here a very, very important question, okay? And this question is this, is what in life should you control? Now, everybody's going to have their own answers, but for me personally, there's three things in life that I believe that we should control, or at least want to control. So one of the first things that I believe that we should control in life is money, because money allows us to do a lot of things. Money is just a tool. So yeah, the second one that I believe that we all should control as well is our time, because time is one of those things that once it's gone, it's not coming back, right? Money can come and go, but time cannot. So controlling time for me, by the way, it's one of my most important things in life. It's why I live where I live. I travel and still do the same things. I love to travel with my family, mainly during the summertime, not during the wintertime. But yeah, I do what I do wherever I'm at. So I love to control time above all else. But there's one thing that you have to control above all else if you want to control the rest of your life, including time and money. And that one thing, it's your mindset. It's that knowledge. It's what's going on between, your ears. And that is one of those things that when we're young, we don't control our mind, right? We're being taught things, we're taking things in, we're being subconsciously programmed. Well, guess what? If you want to change your situation, change your financial life, it kind of starts right here, right? It starts with your mindset. If you want to control time, want to control money, you've also got to control the way that you think about around those things and the way that we believe how money works. And so on this presentation, I am going to be challenging our way of thinking about money and how money works and how it can work for you. So just keep an open mind is one of the things that I just request and ask here. Now, I like to share this quote here at the BYOB team. We love this quote, and it's by Will Rogers. And this quote says this: "The problem in America isn't so much what people don't know, it's what people think they know that just is not so." So once again, keep that open mind. All right, now I want to share something with you. And this is something that when I first heard this, it kind of blew me away because I didn't think this was possible. But let's just imagine this. Imagine you take 100 18-year-old kids. So I'm going to call them kids, right? 18-year-old kids, and you put them all into one big room and you ask every single one of them, hey, where will you be age of retirement? Do you think they're going to say, I'm going to be broke and poor? Of course not. They're not going to say that. They're going to say, hey, I'm going to be successful. I'm going to be a billionaire, right? I'm going to be a multimillionaire, so successful. But here's the truth of it. If you fast forward to when they're 65 years old, only five out of those 100 18-year-old kids at the age of retirement, 65, will be financially secure. Not free, by the way, just secure. The other 95% are going to be poor or broke or financially destitute. And if you're thinking, how is that even possible here in, one of the richest countries in the world, United States, where there's opportunities everywhere? How is that? Well, guess what? Who is saying this? It's the Social Security Administration. So that administration says, because they track these things, that only 5 out of 100 are going to be financially secure. That is crazy, by the way. So here's a good question to think about. Do you want to be one of those 5%? So if you want to be one of those 5%, obviously that's why we're here. That's why we're talking about this concept. Yeah, because that's what we want to focus on. Like, how do you do things differently so that you can be one of those 5%? Now, you might already be at that level. You might already be there, but how do we even maintain that and actually make sure that the next generation and the next generation for our families are also part of that 5%? So that is what we're going to be talking about here today in this presentation. Yep, 5%, exactly. So now you guys don't know me from, your neighbor down the road. So who am I? So my name's obviously Brian Fouts. I actually did the traditional path in life. I went to school, went to Washington State University, go Cougars, if you guys know them, and I got a degree in construction management and business. And that's what I was taught to do. That's what I was programmed to go do, go to school, all that kind of stuff. Now I call that the hard way. Now, why is that? Well, I was raised lower income, great family, by the way. My parents are still together, all that kind of stuff. So very grateful for that. But I was raised without any money. Didn't really understand it, didn't really think about it, was never talked about in my life. And so I followed that traditional path, go to school, get good grades. Kind of. I kind of got good grades. Not to say I did great, but I did well. And then I got that corporate job that we were told to go get, right? Save, have a 401k, get that car loan, do all that kind of traditional stuff. House and growing family, the white picket fence, right? All that stuff. Now, I was told I had the American dream. Maybe you felt the exact same way. I'm working for this American dream. Well, for me, it felt like there was the American nightmare. I was like, what am I doing? And one time I came across this financial magazine in a doctor's office while I was waiting. They didn't have cell phones back then to, distract us. And I picked it up and read this article about millionaires, that they all know their net worth. Well, I don't know my net worth, and I'm obviously not a millionaire. So I was like, oh, this is kind of crazy. So I went home and did the math. That's the piece of paper right there that I did the math on. I took a picture of it a long time ago. I don't have it anymore. I lost it. But I had a negative net worth after 10 years in corporate America. And I realized at that point in time, if I don't do something different, nothing's going to change. And I'm doing the exact same thing that everybody around me is doing. And so that kind of kicked me off on a journey. But one thing happened too. My grandfather, so this is, maybe you guys can relate to this. So, I had a grandfather. He worked his butt off in his career. He was a local high school coach, and very well known, pillar of the community kind of guy. And he worked late into his 60s. He was working for his retirement, and he had this big plan. So he retired, and they bought a motorhome. My grandmother and him bought this motorhome. They're going to travel and go to all these big sporting events around the West Coast. And he did that for about a year, but then he got really sick. He ended up getting leukemia. He got Parkinson's disease, went on dialysis, and eventually he passed away. Before really ever really experiencing very much of his retirement. I remember his last thing he told me one time was, live your life now, don't wait. That was one thing he told me before he couldn't speak anymore. And I took that to heart. So I kind of left my whole career, and I came across infinite banking, by the way. So I came across infinite banking. Now, anybody can say anything online, but this is one of my businesses this is during COVID, by the way, 2021. This business did about a little over 2 million in revenue. Not going to say it was highly profitable, but it was a fun business. And I did it through teaching these kinds of concepts. I was teaching infinite banking to a lot of people, and I had a lot of fun doing it, and it allowed me to do a lot of fun things. So remember, control of time. So for me, I love to control my time. So during COVID, while everybody else was locked down, I was traveling. My family and I were having a blast. I was teaching infinite banking, using the concept in my own life, and had a lot of fun. And this is actually me on at a very high level mastermind. Actually, and by the way, it's in Florida. This is in Sarasota, I think, teaching this concept to other people so they can actually learn how to, do things differently with their money. So this is my passion. I love teaching this concept, and that's what we're going to be talking about here today. Just want to give you guys a quick background. I've been teaching infinite banking for about 9 years so far, so quite a long time. Now, who else is talking about this? I want you to understand this concept, infinite banking, is not new. It's been around for almost 200 years. So who talks about it? Well, Robert Kiyosaki. You can actually read his book. I recommend this one. I like it a lot. It's his book, Second Chance. He talks about it. And by the way, one of Robert's advisors was my mentor for infinite banking. So that's the circle that I was in when I learned about this. Tony Robbins, I've been to quite a few of his events, walked on fire, all that kind of stuff. He talks about in his book, Money Master the Game. Then, of course, there is the kind of the cornerstone book around this concept. It's called Becoming Your Own Banker by R. Nelson Nash, Unlock the Infinite Banking Concept. He's the one that really popularized the concept and the term infinite banking. So a great book there. And then, of course, my friend and mentor, Brent Kessler and Chris Naugle, they have a book called Mapping Out the Millionaire Mystery. I recommend that one as well. And then, of course, Chris has also the Private Money Guide, which is how to become a lender through this concept. One thing also to understand is, well, okay, Brian, who else has used this? Because I have not maybe heard about this, or I've heard a little bit, but who else has used this thing throughout history? Not just today, but in the past. So kind of some cool things. So Jim Harbaugh, he was one of the highest paid college coaches at that point in time. He paid a lot of money, right, at the University of Michigan, and they paid him through this concept. And it was pretty amazing how they did it. I'm not going to break it down today, but it was pretty cool how they did it. So they actually did it, and they talk about it right here. This guy, you may have heard about him. His name's Joe Biden. Joe Biden actually has 6 policies. He disclosed that, or his wife did actually a while ago. Walt Disney. So it's kind of cool. So Walt Disney, if you know his background or his story, he could not get financing to start Disneyland. And so he went to all these banks. They all said no, but he had this kind of policy in place. He had cash value in a life insurance policy. He used that to actually start Disneyland. And that's, of course, how it became what it is today. So pretty cool there. McDonald's. So Ray Kroc, the gentleman that partnered with the McDonald's brothers and took over McDonald's, he actually during the first 8 years used this concept to fund the growth of McDonald's. So it's kind of weird. Without this concept, we wouldn't have Disneyland, we wouldn't have McDonald's as we currently know them today. The Pampered Chef, same thing, borrowed a small amount to start the Pampered Chef, which is now I think $1 billion company that Warren Buffett owns. And then of course lots of families like well, iPhone, whatever your name is, said right there in the private chat, says Rockefellers, the Vanderbilts. Yes. So JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers. The Rockefellers, by the way, have been doing this for, I think, 150 years or more. They've been doing it for a long time. So, and now you. So this has been used throughout history. Now, to understand, though, why infinite banking, why would we want to do this? So here's some things that it can do for you. So one, it creates guaranteed generational wealth day one. Not year 40, but day one, it creates that tax-free generational wealth. It allows your money to grow uninterrupted, compounded for the rest of your life with guarantees. By the way, I love the word guarantees. It also protects your money. If you're going to make money, you also want to protect it. So it does that from lawsuits, from bankruptcy, divorce, court orders, creditors in most states, by the way, because it is state specific. I can always help you understand what your state laws are if you want. But also, very importantly, it allows you to be the bank for things that you may normally use a bank for. And I'm talking about things like real estate investing, paying off debt, college, cars, homes, investments, retirement, all while having all of the benefits above. So most strategies will give you like 1 or 2 benefits. Infinite banking does all of these things at the exact same time, not one or the other, but at the exact same time. So when you have all these things working together at the same time, is your ability to build wealth, to create that legacy, to protect your money going to be better or worse? It's going to be better, of course. It's going to be better. So that's why infinite banking can be very powerful. We talked about mindset at the very beginning. Now, this is kind of an analogy that I want to really quickly put out there. So who learns quickly? Well, kids do, right? It's kind of weird how fast kids can learn. Now, when you were young, you probably learned how to ride a bike. I did. I still know how to ride a bike. I don't have one, but I can hop on a bike and ride it just fine, right? Now, when you first rode a bike, right, it was pretty easy. Handlebars go to the go left, your tire goes to the left. What would happen though if a bicycle or a bike did not work the way that you were taught or the way that you learned how to do it? So this is called the backwards bicycle. You can go Google the video. It's pretty funny to go watch it, do it after this presentation, of course. But in this video, this gentleman, he hops on a bike. Now he knows how to ride a bike, but this is the backwards bicycle. The backwards bicycle, if you turn the handlebars to the left, the tire goes to the right. So he hops on this thing and he tries to ride this thing and he immediately falls over because it's going the opposite direction, right? He is not programmed to ride the backwards bicycle. It's the same thing around money though, by the way. So the way that we think about money might be wrong. Now this gentleman, he learns how to ride the backwards bicycle. It takes him some time. And now all of a sudden he can ride the backwards bicycle. He reprogrammed the way that he thinks about how a bike works. Now, here's the funny thing, though. What would happen if he gets on the regular bicycle now? Well, that's what he does. He gets on a regular bicycle, and now he cannot ride a regular bicycle because he's relearned how it works. By the way, same thing around money. How you think about it might not be correct. And when you learn how money really works, it can be very hard to go back to the old way of thinking around money. Now, one thing we're going to challenge here, the way that we think about money, is where your money goes first. So that's the challenge, is where does your money go first? We're going to talk about that. Now, some things I want to make sure that we think about when it comes to, money. So why aren't more people successful when it comes to money, wealth like that? So here's the wealth killers. So one, taxes. I don't mind paying taxes, but I'm a lot happier paying a lot less, by the way, right? Inflation, that they call the hidden tax or inflating of the money supply. Volatility. So volatility, the markets can, can really ruin wealth. Interest. So interest is that one thing that we get so used to paying that we don't realize how damaging it is to wealth. Then, of course, there's mindset, following that status quo, fear of missing out. Life in general, by the way, what we're taught, all that kind of stuff in life can really destroy wealth. That's why a lot of people aren't more successful. A lot of it's what's going on between our head right here. Some mysteries around money. So some quick things I want to make sure that we are clear on. So what is the definition of money as we're talking about in this presentation? It's just a means of exchange. That's all it is. What company uses compound interest, by the way? So most people will say banks use compound interest. No, they don't actually. They might pay compound, but they don't really use it themselves because all they're doing is putting money into motion to make more money off that money. So there really is not a business that really uses compound interest in the way that we're going to be talking about it. Also, think about this. Are your dollars worth more today or in the future? 20 years ago, if you went into a candy store with a dollar bill, could you buy more than one thing? Of course you could. You could come out with, probably 4 or 5 things. Today, you might go into a candy store with a dollar bill and maybe buy half a candy bar. So your dollars are worth more today than they are in the future. So just keep that in mind. Do taxes go up or down? Well, they have gone down at some point in history, typically after a war, because they go up during that time. But generally speaking, taxes go up, right? So why do I ask that? So would you rather pay interest or taxes on the seed or the harvest? So what I mean by that is, let's say you go buy $5,000 worth of seed and you plant that seed, and now 6 months later you harvest it for $500,000. Would you rather pay taxes on the $5,000 seed or the $500,000 harvest? Most people say the seed. Todd says it right there. Yeah, exactly. That's what we'd want to do. But guess what? Do you understand how your 401k works? It's the opposite, by the way. You're paying taxes on the harvest, not the seed. And since taxes go up or down, would you rather pay taxes today or down the road if they're higher, right? So it's kind of weird. Another question to kind of think is this: would you wait to eat bread or drink milk? Would you go and buy bread, buy milk, put it in the freezer for 20 years, and then eat it down the road? No, of course not. It's not going to be very good. Maybe it multiplied by 2, but it's still a freezer bird. But that's what we do with our money. So it's kind of interesting. So think about a retirement account, like a 401k, IRA, things like that, where you put your money in. You can't touch it, you can't use it, you can't control it, by the way. And then you take it out down the road. That's the harvest. And now you're paying higher taxes on the harvest instead of on the seed. So it's weird. We will do things with money that we would not do with things that money buys, like food, a car. We don't wait to use those things, but we wait to use money. It's kind of a weird thing, by the way, but that's where the mindset kind of has to change when it comes to money. Now, also, if we're talking about being our own bank, which is what we're talking about in this presentation, we got to understand how money flows, right? How does money flow through our lives? So let's use a car as an example, because a lot of us have bought a car, whether we paid cash, whether we financed it, or maybe Grand Theft Auto stole it. Doesn't really matter, right? But let's just look at a car as an example. So let's say we're going to go get a $25,000 car. Now, let's just say that you happen to have $25,000 in your bank account at the local credit union, okay? And you're going to go get that cash and you're going to buy the car for cash. But your banker says, hey, wait a second, Brian. Before you take the cash out to go buy the car, let me propose something different. How about this? What if instead of taking the cash out, I give you 4% on the money in the bank, and I give you a loan for $25,000 with your cash as the collateral. And I'm going to give you that loan at 6% for 60 months. I'm going to pay you 4% for 60 months on your cash. So is that a good deal? Does that make sense to keep your money in the bank at 4% while paying a $25,000 loan back at 6%? Does that make sense or not? Todd says yes. So why is that? Why does this make sense or not? Now, this is how banking kind of works, how money flows. So your payments on the car are going to be $483 per month for 60 months, which means the future value of all of those payments together is $28,999. But this is what's pretty crazy. What's the money in the bank now? The future value of that money earning 4% is $30,525, which means what? It means that you actually made $1,526 by keeping your money in the bank, earning 4% while paying 6%. Now, why is that? Of course, why is that? Let's kind of wrap a bow around this thing. It's because your $25,000 at 4% is growing. So you're earning 4% on an increasing balance, while the debt you're paying, the $25,000, is you're incurring 6% on a decreasing balance. It's just math, by the way. Yep, and Todd says the debt is linear and goes down, but the money in the bank goes up. So that's what's happening. They're going like this. They're going opposite directions. That's called compounding versus simple. Earn compound, pay simple. You're earning compound on your money and you're paying simple. That is like one of the rules about investing. Earn compound, pay simple. I'm going to say it multiple times. There you go. Now, someone might say, well, Brian, wait a second. If I paid cash for the car, I wouldn't have any payments to make. That is true. That is true. But let me ask you a question. How did you get the $25,000 in cash in the first place? Well, Brian, I got it because I was saving $500 per month or whatever it is. Okay, so if you pay cash, you have no cash. You have no future value of the money. Are you going to save up again? Well, yeah, I'll keep saving. Okay, so if you're saving into the bank account or you're making a loan payment back to the bank, is the cash flow the same? Yes, it is. But one makes you $1,500, one makes you nothing. There you go. Very simple math. Now, this is when you involve a bank. Now, what we're talking about, though, with infinite banking is being the bank on both sides of the equation. You own the bank and you own the loan. So that's what we're going to get into in a little bit. All right, so what is the money multiplier method we're going to be talking about here today? So number one is the machine. We're going to go through what the machine is and how this works. We're going to go through the next thing, which is the marathon, okay? How do you put this to work? How do you build wealth, right? It's the marathon. This is not a sprint. It's not get rich quick. It's the marathon, right? That's how we build lasting wealth and generational wealth. Then, of course, everybody's favorite topic, the millionaire. How do you build not just, millionaire, but a multimillionaire for this generation and generations to come? So that's what we're going to be talking about. So let's dive into the machine. So when it comes to infinite banking, by the way, what is the machine? So why do I say this? So think of infinite banking like a car. A car has all these features, tires, wheels, brakes, hopefully, radio, all the kind of stuff. But if the car does not have an engine, can it go down the road? Of course not. So what is the engine that allows infinite banking to function and exist? It is nothing more than a specially designed, by the way, specially designed, dividend-paying, a permanent whole life insurance policy with a mutual insurance company. Now, why life insurance? People say, well, I'm healthy, I don't really need this. Because it is the best vehicle for infinite banking. It has all of these layered benefits that make this thing very attractive. It is the best engine for this vehicle. One other question I get is, well, who's really doing this? I mean, so once again, wealthy families, average families are doing this. But one of the biggest buyers of whole life insurance, these kinds of policies, by the way, is banks. So by the way, so the banks, when you go look at all the banks in the corner of, the downtown, right? They got these nice buildings, all this kind of stuff. But here's the crazy thing. Banks own more whole life insurance, by the way, than all of their real estate and buildings combined. And they quadrupled their holdings since 2016, by the way. So do they do something that maybe we should be doing? Or do they know something that we don't know? Yes and yes, by the way. So we're kind of doing the same things that banks are doing with our money. So, and you can go look it up, by the way. It's called BOLI, or bank-owned life insurance. You can go look it up and it'll talk about how they do this. It's pretty crazy. So we're just doing the same things they're doing. All right, so now we got to understand how our money flows. So once again, I showed you how money flows through the car example, right? How we can make more money earning 4% while still paying 6%. Just math, by the way. So we want to be on both sides of that equation. That's how this works. So now to understand how, why we want to be the bank, we got to understand what our banks are doing with our money. So I'm going to go through that right now real quick. And Robert says the two largest buildings in major cities are banks and insurance companies. Exactly. But here's the crazy thing. Which one do you think is more financially stable? This is a great question right here. So he's correct. Insurance companies are very profitable, but mutual insurance companies are owned by who? Not stockholders, but the policyholders. And during the Great Depression, how many banks went under? 9,000 banks, or 50% of all banks went under. How many mutual insurance companies went under? Zero. It's never happened. There you go. Which one do you think is more stable? Most people look at insurance companies as very stable compared to banks. How does a bank function? How do they flow money? So let's just say that you put in $100,000 to your checking account, and let's say this very nice bank is going to give you 4% on your money. That's awesome, right? 4%. So, but do they just sit on your money? Do they sit there and just look at it? Of course they don't. No, of course they don't do that, right? They put your money into motion. So maybe they lend it out on a mortgage or a 7-year ARM at 7%. Now, what does the seller of the home that got your money do? Well, it goes right back into the bank again. So what's the bank do? They do not sit on the money. They put it right back out. Maybe it's at 8% on a car loan. My neighbor just got one for 9%, which was staggeringly high. I couldn't believe she did that. But what's the car company do when they sell the car? Well, it goes right back into the bank again. That's all they're doing. They're just putting that money back into motion. Maybe they lend it back out, maybe a home remodel, a home renovation loan. What's the contractor do? What do subcontractors do? Well, they put it right back into the bank again. What's the bank do? Puts it right back into motion. Maybe a debt consolidation, loan to somebody. What's the credit card companies do? It finds its way right back into a bank again. So that all being said, if a bank is paying you 4%, they're actually making 500% more on your money than they're paying you. It's just math, by the way. So a bank puts money into motion. That's how they make money. So when we want to be the bank, we want to do the same thing, right? We want to make that money move. So, and someone says, yeah, during the Great Depression, they bailed out banks. Some of them they did, but keep in mind, everybody was in trouble. So a lot of the banks just went under and poof, they were gone. And then banks are lending institutions, not saving money institutions. Yes. So banks exist to borrow and lend money. That's what they do. Well, that's why we want to replace them, right? So we want to be the lending institution, not the bank, so that we can get the benefits that the banks are taking from us. Now, by the way, this is not just a random guess for how much they make. You can actually go to bauerfinancial.com and they actually will show you how much banks make on the money that you leave there, between 400 and 1300%. And you can actually even go back into history and see how much they've made historically. It is a lot of money. Now, people say, well, Brian, if that's how much money they're making, why do they go under? Because banks do things that are very risky. One of those things called fractional reserve banking, which is extraordinarily disastrous to our money supply. It's one of the leading causes of inflation. I won't get into it today. I could get into it in a whole other presentation, but banks do very disastrous things that destroy money. Now, once again, they make a lot of money, but they also destroy money too, in my opinion. So very, very risky, but yeah, you can go look this up. It's crazy. Now, in order to be the bank for ourselves, we also have to understand how people spend our money. Okay. So what I want to look at is for every dollar that comes in your household, where does it go? All right. So let's look at this. So for every dollar that comes in, around 20 cents goes to automobiles, payments, gas, upkeep, etc. 30 cents of every dollar goes to housing, rental, mortgage, things like that. 40 cents goes to everything else, travel, entertainment, food, clothing, all that kind of stuff. So that's 90 cents. So 90 cents of every dollar that comes into our hands, typically on the average family, goes right back out to somebody else. And 10%, if you're lucky, you retain as savings, whether it's into a 401k, cash savings, rainy day fund, IRA, whatever, pension, maybe something like that. So, and by the way, before COVID, I think this number was a negative number. During COVID, it went up, by the way, and now it's come back down again. So I always say 10%, but that number fluctuates greatly depending on the economy, what's going on. So we're not going to be sitting here talking about your savings. Yes, 10%, 50%, you should be putting somewhere. Infinite banking, 401k, whatever. But I'm not going to talk about your savings because we want to increase your savings. So we're going to focus on the interest that is going out to everybody else. All right. So let's look at that. So let's start with 10%. That's your savings. Now let's look at the interest that's going out the door. So when it comes to automobiles, I said that 20 cents goes to that, but 5 cents of that 20 cents is interest. What if we recaptured that back into our savings? Our savings is going to go up. Let's look at housing. 30 cents goes to housing, but here's the crazy thing. 25 cents of most housing, mortgage interest, by the way, is going to somebody else. What if we recaptured that 25 cents? Okay, that would all come back into our savings. The last one, which is everything else, which is 40 cents, around 5 cents, mainly credit card interest, goes out to somebody else. What if we recaptured that? So you can see here, if you recapture interest that's going to somebody else and put it back into your hands and your control, you can start to build wealth. So it's a switch. It's a mindset switch as well, by the way. So you can see how this can do this. So we're going to talk about how you can do this. So what I want to show you next is an example of how this can work on a traditional purchase. So I'm going to use a car as a traditional purchase because most of us had bought a car, whether with cash or a loan, etc. Now, obviously, I love classic cars. I don't have an Eleanor right now, which is what that car is. It's a Mustang. I do have a Mercury Cougar that I restored, but I like classic cars. Typically, you can't finance them, but let's use this one as a traditional example here. Let's look under the hood of what the engine is for infinite banking. So as I said, this is a life insurance policy specially designed. So what you're going to see here, this is what's called a tabular detail. You're going to see the policy, you're going to see the age, and you're going to see what are called deposits. Now, when you have a premium with a life insurance policy, that can be monthly, quarterly, annually, whatever you want. I'm going to call that a premium deposit. Why is that? Because with a premium, it's an expense. But with a deposit, you can use it. So you're depositing into your policy so that you get value back out. You'll see that over here. That's called cash value. Now, these are very, very conservative numbers. And if you don't see the numbers, can't follow the math, don't worry about it. I'm going to kind of keep this high level just so you guys can understand the overall concept. And then on a one-on-one, we can dive into the actual specifics. Okay, so this is deposits right here. The other thing I want to mention is age. So a lot of people talk about, well, I'm 55, can I do this? I'm 65, can I do this? I'm 25, can I do this? Yes, and yes, and yes. So age doesn't typically matter. I have clients that are in their early 70s. I have clients in their 60s. Yes, this can still work. And you can also do this on other people, not just yourself, by the way. The last thing I'll mention here is death benefit. So a lot of people talk about death benefit when it comes to life insurance. We do not focus on the death benefit. It is a side benefit, but not the main one. So I'm not going to talk about that one a lot. I will cover it in a little bit later on, but we're going to focus on what is called the living benefits, which is how to use the policy, borrow from it while we are alive, not death benefit. Okay. Let's get into the details on this one. All right. So in this example, I'm going to assume that this person is going to do a $10,000 deposit every year. That could be monthly, could be annually. Let's just use $10,000. Now, that $10,000 is going to gain cash value inside this policy. Now, once again, these are very conservative numbers. In the ones that I build, it's going to be a lot higher. But once again, I want to show you the power at a very conservative number here. Now, what you'll see here is at the end of the third year, this person says, okay, I have built up close to $25,000 of cash value. I'm going to go borrow that cash value out. And I'm going to go buy a car. They're going to pay cash for a car. By the way, paying cash gets you a better deal. I've had fun doing that. Now, we're going to be responsible. We're going to be a responsible banker. We're going to pay back this policy loan to our banking system. So let's just choose $500 per month, 5-year note. That's $6,000 per year, 5-year note. So you can see here, they're paying this loan back. What does it look like at the end of year 7? At the end of year 7, this person has put in $70,000 of deposits. They've also paid back $30,000 on the car note. But yet they've also, keep in mind, they took out $25,000 of cash. So they actually took out $25,000. So in reality, they have put in $75,000 into this infinite banking policy. And at the end of 7 years, they have recaptured 91 cents of every dollar. Where's that 91 cents coming from? It's $75,000 versus 67,000 of cash value. So they put in 75, but they've recaptured 91 cents and they have the car. But now this is where infinite banking really just takes off and kind of blows everything out of the water. So let's look at years 8 through 12, the next 5 years. Now this person decides in years 8 through 12, you know what? I don't want to put in any more money into this policy. By the way, you can do that. You can choose to go to 0 on the premiums. Not recommended because it'll grow faster the more you put in. But let's just say for example purposes, we put in 0. Okay, no more goes in. But guess what? Because you're earning dividends, the cash value and the death benefit, by the way, continue to grow and go up. So once again, let me repeat that. You put nothing else in, but the cash value, what you can borrow, keeps going up along with the death benefit for the rest of your entire life. So what happens in year 8? In year 8, this person says, hey, guess what? My daughter just turned 16. I'm going to buy her a car. Nice parents, right? I'm going to buy her a car. My daughter's 15. I'm dreading here a year when she turns 16. But they purchase another car. But they're going to do the same thing. They are going to pay back that policy loan. Same note, same terms, $500 per month, $6,000 per year. So what happened in years 8 through 12? Well, they put in 0, they paid back 30, but they took out 25. So they really only put in $5,000 into this policy in years 8 through 12. But guess what? From year 7 to year 12, they put in 0, but the policy grew by $23,592. Would you guys like to see that in your life? Put in 0, but it grows by 23,000. That is incredible. Now, let me explain one other thing that happened here. So how much has this person put into this policy? $5,000 plus 75. That's $80,000 they put in over 12 years. 80,000. But what do they have access to? $91,000. So their money grew by over $11,000. It grew, and they own 2 cars outright. Let me repeat that. Their money grew by $11,000, so their wealth increased, and they own 2 cars 100% outright. That's amazing right there. That's just a different way of flowing your money. That makes sense? So that's just a quick example of how this can work. A very, very simple example of how infinite banking can work with a traditional, purchase. Now, just imagine what if instead of being a car, that was a real estate deal that cash flowed. You'd have even more cash flow and more wealth in your life. What if you private lent that money out to create more cash flow? Instead of actually making $11,000, you could have made $20,000, $30,000 while having both the cars too, or both the real estate properties or whatever. So there's lots of things to do with this, but that's just one very simple example. Now there's 3 rules. You'll see them right there. Rule 1, pay yourself first. 2, be responsible. And 3, recycle your money. So what are those rules? Once again, pay yourself first. We're so used to paying other people first, we've got to learn to pay ourselves first. Number 2, pay yourself back, be a responsible banker and pay yourself back with interest. If you're going to pay a bank with interest, pay your own bank with interest, right? You're going to benefit. And the last thing is recycle and recapture your money. That means use the system. Keep the money flowing through the infinite banking system and it's going to build wealth. So if this works for a car, what else does it work for? So one of the other big things that steals wealth, by the way, that takes money away is debt. And so I'm going to go through this example fairly quickly. I want to make sure I'm respectful of you guys' time, but this is one of the most common things that people use infinite banking for, myself included, by the way, is to pay back or recapture bad debt because that steals wealth. So how does this work? So I'm going to give you an example here. This is actually a real kind of life example. I'm once again very conservative on the numbers, but this is a doctor, 45 years old, 9 third-party debts. So a lot of debt, over $478,000 of debt. All right. And total payments on those debts were $5,777 per month, or almost 70 grand per year. And that doctor, if he paid back those debts as planned, it'd take him 19 years. All right. So this doctor said, hey, I don't want to do that. Came to our team and we built them out a very simple policy, by the way. So what are they doing? So this doctor said, hey, I'm going to start a policy. I'm going to do an annual premium of $25,000 per year. And someone might say, well, Brian, where's that 25 coming from? Well, this is a doctor, by the way, and he was putting a lot of his money into things like a 401k, deferred plan, IRAs, things like that. And he didn't really like those things because he felt like he didn't control them, but he didn't have a choice, is what he told himself. But guess what? With infinite banking, he said, hey, I'm going to take some of my money that's going into this bucket over here, call it a 401k. I'm going to divert it into the infinite banking bucket. So his cash flow did not change. Keep that in mind. Now, immediately within 30 days, he had access to around $14,863 of cash value inside his infinite banking policy. Once again, very conservative. I'd want that number today to be around 19,000, but once again, very conservative here to show you how this can work even with an average policy. All right, so what does he do? So he goes and borrows out $14,000 from his policy. He pays off the Discover card, the Lowe's card, and part of the Nordstrom's card, which means his debts drop down, total debts drop down, and his monthly payment dropped by $448 per month. Now, does he just let that $448 per month go out and just be spent on other frivolous things? No, we want to recapture the money and recycle it. Remember rule number 3. So what's he do? He takes that money and he saves it aside. So next year, at the beginning of year 2, another 25 goes in. Cash value now grows by $16,571, and the payments back to himself that he's saving, the $448, is worth $5,374. So the total cash this doctor now has available to borrow out is $21,945, and that's what he does. He borrows it out. He pays off Nordstrom's, Wells Fargo, private loan, and part of the BMW, probably a car loan or a motorcycle. And now his debt's dropped, and his monthly payment dropped now by $1,917. Does the same thing. He saves the $1,900 into his policy or his checking account. Next year, another 25 goes in. Cash value jumped up by $25,000 that year. Payments back to himself of $1,900 are $23,004. Total cash is now $48,000. Guys are kind of starting to see what's going on here. He borrows out $48,000, pays off BMW, West Marine, and part of the condo. His debts have dropped a lot. Now keep in mind, I'm going to pause here for a second. His debts are decreasing and coming off his credit report, but where are the debts going? They're going into his policy loan. So his policy loan on his own banking system is going up because he's moving the debts from a high interest to a low interest environment. That's what's going on. Because now his monthly payments have dropped by $3,677. Now, once again, I want you to understand the marathon here. This is the marathon, not the sprint. So how much has this doctor put in? $75,000. How many loans? 3, totaling around $55,000 and change. So how much is left in his policy earning him dividends? Because remember, these earn dividends. These grow no matter what you're doing. It's not $20,000. He's earning dividends on the full amount that he put into the policy, right around $75,000. So even though he's borrowed against the policy, he is still earning the same dividends on the same amount of money. Like that's just incredible just by itself right there. All right, let's get back to it. All right, so in year 4, once again, 25 goes in, cash value goes up by $26,000. The payments back to himself are now $44,124. Total cash is 70 grand. So what's he do? Borrows out 70, pays off a huge chunk of the condo. Now, The condo and the house are amortized loans. So the payment does not change because when you pay down a principal on an amortized loan, your payment does not change. So his monthly payments in year 5 or through year 4, by the way, don't change. Now in year 5, what happens? 25 goes in, cash value goes up by 27,000 and change. Payments back to himself are 44,000 and change. Total cash value 71,000. What's he do now? Now he wipes out the condo. Now he owns it, by the way, not the bank. He has title, and he wipes out a huge chunk of the house. Monthly payments now have dropped by 4,556. Now, this is kind of interesting. This doctor was like, holy cow, this is amazing. I want to do more. I want to do another policy. So in year 6, at the beginning of year 6, this is what happened. So the original premium on the first policy was 25,000. He reduced it down to $10,000. You can do that, by the way. He reduced it down to 10,000. The cash value still went up by 13,000 though, and he did a second policy with another 25,000 because he has more cash flow now. That cash value is 14,000. The payments back to himself are $54,000. So the total amount he has available now is 82,000 and change. What's he do? He borrows out 76,000 and wipes out the house. Okay. Now his debts on his credit report are 0. His monthly payment is now 0. Now that's what happens. Now what happened after this? So now he's paid back all these debts. He's freed up 5,777 of cash flow. Year 6 and part of year 7, he takes that payment of $5,777. He puts it back into his policy loan and pays off his policy loan. So at the middle of year 7, he is now 100% debt free, and he's got 6 figures in his policy that he can now go put to work. He has completely flipped it in 7 years, not 19 years, by the way, 7 years. He has completely captured all of his debt, paid it all off, and now has 6 figures, multiple, that he can now put to work in cash flowing assets. Completely changed his wealth and his life, his financial life. Now, if you're saying, well, Brian, I have no idea what you just said. Well, guess what? We have software that does this for you. Part of that software is called the Vault. So we call this our debt blaster, but we have software that if you want to use, will map out exactly what I just showed you. It'll map it out on a monthly basis, show you where to flow the money, how to do it as effectively as possible. And so we have all these resources for you, by the way. So essentially we have what's called an implementation team that does this. It'll work with you on how to use policies, by the way. So if you said, hey, Brian, how do I do this? How do I borrow? How do I pay it back? What's the best structure? Don't worry about it. We got you covered. That's what our I team does. Kind of like your own personal blueprint for how this will work. So I want to give you a heads up on that. So yes, we do that for you. The third thing I want to talk about is the millionaire, right? This is, everybody wants to be that millionaire. How do we do this? So the question I get quite a bit from someone at this level is, well, Brian, what if I don't have any bad debt? Or what if I don't need that new car? Can I still do privatized banking or benefit from being my own bank? Yes, because guess what? That's when things get a lot of fun. That's when we start to build that wealth, build that legacy. All right. So how do people use infinite banking to create, wealth? Real estate investors do this. That's how I got my start outside of corporate America, was real estate investing. Commercial property, so apartments, private lending, all that kind of stuff, private funds. You can be a bank to another investor, as an example. Hard money lending. A lot of business owners use this as a line of credit, that kind of stuff. Stocks and options traders do this. I don't. I know some guys who've done that. I don't do that, by the way. But yeah, they can. And then startups, a lot of startup people. And then of course you can, do equipment flipping. We got members doing that, where you can flip, equipment for profit, all that kind of stuff. So what I want to show you right now, because there's a lot of ways to use these policies to build wealth after you've taken care of debt, after you've taken care of purchases. So I want to do an example of private lending, because that's what a lot of people, a lot of our clients do. I've done private lending, all that kind of stuff. This is what is called a tabular detail for an actual policy. This is a real policy. So you're going to see the contract premium right here. You're going to see over here on the right-hand side, we don't look at the left-hand side. We look at the right-hand cash value and increase in cash value. And then of course, there's your death benefit. This person is putting in a $50,000 per year premium. Now that's just their numbers. Your numbers are your own, but this is what they wanted to put in. Okay. Also, you're going to see in the first year, $150,000 has gone in. Why is it 150? Well, you can overfund the cash value at the beginning of the policy if you want. You say, hey, Brian, what if I want to put in, in this example, 50,000 per year, but I also have 100,000 sitting over here. Can I put that in too? Yes, that's called a dump, and it'll give you a lot more cash value early on. So that's what this person is doing. What I want to show you is how these policies perform, especially over time, because the longer they're in place, the more and more powerful they become. So in this example, in year 8, the cash value, the banking system grew by $66,722. That's pretty awesome. But how much did they put in? Well, they only put in 48,594. So you see it right there. That's how much they put in, but it grew by 66. So what is the cash on that return? Well, that's a 37% cash on cash return, right? Who here wants a 37% cash on cash return? I do. I mean, that's awesome. That's awesome right there, right? So I want that kind of cash on cash return, but how does this make that even more powerful? Well, guess what? Let's say you're going to private lend the money at 12%, traditional rates, right? And let's say the interest on your policy is 5%. That means that by private lending the money outside of the policy, your cash value or cash on cash return is now 44%. So we did nothing except where the money went first. It went through the policy first, and then they private lent the money, and they're making a 44% cash on cash return on their money. So we have private lenders that are making 12%. They think they're doing great. Then they see this and they're like, oh my gosh, if I had done this 5 years ago, I'd be making 44 to whatever it is percent return on my money. Oh my gosh. They're like, oh, I feel sick to my stomach. I should have been doing this for the last 5 years. That's how this can work for you. So does anybody here want to have a 44% cash on cash return? Give me a yes. Shane said yes. Who wants that kind of return on their money? Anybody? Nobody wants that? Building wealth can be very simple if you have the right vehicles, because now this person's money is working twice as hard for them. It's not in one place, it's in two places at the exact same time. And it's also protected and it's private and all these other things. So I'm going to get into, by the way, some of the other benefits about infinite banking so you understand how this can make because it has to make sense to you, not to me. It has to make sense to you. Okay, so how it works though is through uninterrupted compound interest. That's what's going on here. So in this example, this person put in $50,000 right there and around $6,000 per year. Okay, but look at their numbers here. In year 2, cash on cash of 21%, access to capital 121. Year 10, 54% cash on cash, access to capital is 154%. 20 years down the road, 191% and 291% access to capital. They're accessing more than they put in, by the way. That's what that means. They have more capital than they put into the whole thing, which is incredible. So you can see how this thing works over time. It just compounds and compounds. Now, how do you become that millionaire? It's the same way you eat an elephant. It's one bite at a time. It's also like that man at the top of the mountain. Now, this is kind of a funny one to me. Everybody sees that man at the top of the mountain and says, hey, guess what? I want to be there. I want to be there. Somebody take me there right now. But how did that person get there? They took the first step up the mountain. They stopped walking around the mountain and they started going up the mountain. And eventually, guess what? If you do that, you'll be at the top. You don't just magically appear there. You've got to take that first step, by the way. That is the millionaire method, in my opinion. You got to take that first step, that first action. Okay, so this works for, debts, for expenses, for other things, right? So it can work for a lot of things, right? It's worked for a lot of things. Like as an example, like this is a drastic example of how this can work, especially in the long term, right? So remember the homes that doctor had? He had those two, the condo and the house. If he had paid those things traditionally as scheduled, right? He would have actually paid over time out of pocket $493,000 to own for those properties. That's how much interest, all that kind of stuff he would have paid, considering the values of those properties. Now, granted, this is a drastic example. What if he had enough cash value to buy those properties out of his policy instead of getting a bank loan? He got a policy loan. Okay, now once again, drastic example. If he did that, he would have made 749 grand. So he could have actually either paid 493 out of pocket interest or made 749 grand. Drastic example, of course, but that's the power of being your own bank, being in control. Now, if you're asking, well, Brian, okay, how do we map these kind of things out? Once again, we have software, we got the vault, we got things that actually will map this out for you. So keep that in mind. All right, so now that you know how this works, everybody should do this. This is kind of one of those things that when I learned about this, is like, man, I think that everybody that can do this, by the way, should do this. So in order to, if you guys want to schedule a call with me, and by the way, I got more slides, we got more examples. This is just kind of a pause right now. So for those of you that need to hop off, that's my personal call link right there. It's brian.beyourownbanker.com/TBCT. So by the way, it's my personal call link. I'm going to share this slide. I love this one. This is kind of the switch that we want to make in our lives. Most of us have been the guy at the bottom, working for our money very hard. And then we see people on the top where their money's working for them, right? It's awesome. They're making cash flow. They got assets, all that kind of stuff. That's the transition that we want to make. And infinite banking can help you make that transition a lot better. All right, so by the way, some things that we didn't even really talk about that I'm going to go through now in some more detail. The death benefit. We didn't talk about that, but I'm going to share how powerful that thing can be. The loans. So we talk about loaning from our bank. Those loans never have to be repaid, by the way. Now, you should repay them to be responsible, but you control those loans. Also, the values grow inside, the dividends grow, the cash value grows tax-free. By the way, not tax deferred, tax-free. The policies, as I mentioned before, they are exempt from judgments, liens, court orders in most states, by the way, not all states, but in most states they are. You can create tax-free income in retirement with infinite banking. Tax-free income sounds pretty awesome. I got clients that are doing that and building that for that exact purpose right there. All right, let's kind of talk about the death benefit side of this. Now, one of the big benefits of infinite banking is that it creates generational wealth tax-free, guaranteed. That's because the death benefit is a guaranteed payout and it's tax-free. There's no taxes on that. So look at this example. So this example here is a female, age 42, standard policy. And this person wants to put in, and this is, by the way, this is a real policy, real client, putting in $20,000 per year. And this client says at year 6, they want to reduce the premium down to the bare minimum, which is $3,257, or they can go to zero potentially if they want to, but they want to put in this amount. So look at this. In year 1, this person put in $20,000. At the end of the year, the amount of cash value is now $17,000. They have access to cash value within 30 days, by the way, but now it's at $17,000, $17,097. But the death benefit is $325,000. Now, God forbid we don't want anything to happen to anybody, prematurely. But what if this person got hit by a bus? That $20,000 is going to turn into $325,000 for their beneficiaries or family, tax-free, guaranteed. But here's the crazy thing. Look at what happens year over year. By year 5, they have put $100,000 in, but the death benefit has grown from $325,000 at year 1 to $483,000 by year 5, almost 5 times what they put into it as the death benefit. Now look at this. They reduce the premium, but guess what happens? Cash value still keeps going up by more than they're putting in, by more than 2 times. And the death benefit also keeps going up for the rest of their entire life. Major benefit of infinite banking there. Let's talk about those policy loans. Okay, policy loans, they are guaranteed. Okay, the loans are guaranteed. You do not have to qualify. There is no credit check. Just ask and you shall receive. By the way, you log in. That's how you request the loans in most cases. You log in, request it, it shows up in your account. The loans are private. This is very powerful. They do not show up on your credit report. Unlike a car loan, credit card, personal loan, lines of credit, they all show up in your credit report. These are private loans. They do not show up there, so they do not affect your credit report. There is no minimum or maximum payments on those loans because who's in control and who owns the bank? Essentially, you do. So you're the one in control. You choose when and how to pay the loans back. There's also some very cool things about how they charge the interest. These are low interest loans, and you can actually make the interest even lower if you know how to do it. Miss a payment, nothing happens. So once again, if you miss a payment on these loans, they're not going to take your car because you have the title. If you buy a car with infinite banking, guess what? Who has the title? You do, not the car company. If you make a payment, nothing happens. So pretty cool. So you can do it monthly, quarterly, semi-annual, annually, and you can change that during the course of the policy, by the way. The minimum to fund the policy, premium deposit-wise, is around 10 times your age per month minimum. And the maximum is going to be based upon your gross income and your age. So I can work with you on that number, but there's a range of what you can qualify on. There's a low end and a high end, and I can work with you on what the best number is for you. On top of that premium deposit, there's also what is called the dump in, where you can put in a large amount in upfront, typically year 1, but it can be beyond year 1 if you want to. And the majority of that, around 90%, goes to cash value immediately. So you can borrow within 30 days on these policies. And with whether it's deposits, whether it's dump-ins, anywhere from 50 to 90% at the very beginning goes to cash value within 30 days. So they're very, very quick, very, very liquid assets, by the way. So the other question people get is, well, Brian, if I'm putting in $1 today and getting only 90 cents back, well, think about time. So as these policies mature or age, eventually you're going to put in $1 and get $3 back out. Sounds pretty good, right? But let's look at a real example of this. So in this policy, you'll see here, this person put in $60,000 year 1. At the end of year 1, they have $55,000 of cash value. 90%, or actually a bit more than that, actually, I think it is, of what they put in, they have access to. That's pretty powerful. Look at year 2. In year two, they put in $10,000, but the cash value grew by $10,607, more than they put into it. And look at year 11. They decided to reduce premium, but they put in $3,120. But guess what? The cash value went up by $10,590, more than 3 times what they put into the policy. Like, that's the power of compounding, by the way. That is what makes this thing amazing. Additionally, between year 4 and 5, they put in between $90,000 and $100,000, but the cash value is actually growing more than what they put into it. So from this point forward, they have access to more capital than they put into the entire thing, and they've been using this during those years as well. So it's the best of pretty much everything as far as I can tell. So pretty cool how that can work right there. Now, there's a quote that we like to share. It's by Warren Buffett, and this quote says, if poor people would just do what rich people would do, they wouldn't be poor anymore. Now, I don't like that quote because to me, it's not accurate. The way I look at it is this: if poor people had the knowledge of the rich and took action on that knowledge, they wouldn't be poor anymore. Because I'll be honest, it doesn't mean that you do what they do, but you have to have the knowledge first to do what they do. Knowledge comes first, in my opinion. Knowledge always comes first. So some people ask my question, this is, well, Brian, why would I want to work with you versus Bob over here or my State Farm guy? Well, one, State Farm can do infinite banking. They cannot do it. So I've been doing this for about now, but I need to update this slide. It's 2 years old. But I've been teaching infinite banking for 7 years. I am a licensed or certified infinite banking practitioner. I'm a licensed agent, but I'm also certified by the Nelson Ness Institute for Infinite Banking. So there's only about maybe 400 people in the US that are actually even certified. So obviously our team is all certified. We have an entire team. So it's not just me and, a couple people. As many of you know, we have a full team of over 40 people that help you with this. Our team is one of the largest, if not the largest producer of infinite banking policies in the United States. So we have a lot of resources. We are the top broker for many of the insurance companies. So they like us, they know us, they give us a lot of resources, which we pass on to our clients. I have over 100 clients in underwriting at any one point in time, by the way. So I've been doing this for quite some time, but yeah, I have a lot of clients I work with. We also provide ongoing support and services. So it's not like, hey, here's your policy, good luck, right? I have a lot of people that come to me because that's what happened to them. So no, we provide ongoing support. So I have clients that I've had policies for years. They call me up, say, hey, Brian, I have a question. What should I do here? Let's hop on a quick call. Let's go through it. We have a team that actually supports you ongoing. We have all these kind of live events we do. We have 6 live events a week that you can come and learn from. So lots of things like that. So keep that in mind. And then, of course, there's no cost to you. So there is no cost to going through the underwriting process and getting approved for a policy. We are paid via commission, by the way. And if you want to know what that number is, I will literally show you how it's calculated and what our numbers are. But so we take a pretty big cut in commission. We don't get a lot of commission for doing infinite banking. Someone says, another thing that we get quite a bit is, is an IUL or a VUL infinite banking? The answer is 100% no. IULs are not infinite banking. You can go use AI software if you want and ask that same question. You'll find out some pretty interesting things. IULs, by the way, have a lot of lawsuits. They have a lot of legal issues. In fact, there's people that we know that cannot even practice in certain states because of what they have done, and yet they're still selling or pushing IULs. And there are legal repercussions that are coming their direction. I do not believe in those things. We have Chris Naugle has owned a lot of, he actually still owns, I think, some IULs. I have personally owned a VUL, and it was an absolute disaster. So when it comes to infinite banking, we want to use the best vehicle possible, the best engine, so to speak, to make this thing work. And that is a whole life policy. Been around for a long time. IULs, VULs have been around since not a long time. They've been around since the 80s, but they've been popularized during the 2000s. They have not had a lot of history. And there's actually, I have clients that have defaults. Their IULs are falling apart because of how they're built. Their VULs are falling apart. They're losing money. It's disaster. So we don't even touch those things. So yes, we do not touch IULs or VULs, and there are a lot of legal issues. And by the way, we do take a pretty big cut in commission to do these things. A pretty big cut in commission to do those things. And we only do infinite banking mainly, by the way. One of two things will happen to us in life, by the way. Well, we're going to live, right? So do you think you're better off with or without infinite banking while alive? I say yes, up to you. And we're going to die. That's kind of one of those guaranteed things, right? But are we better off with or without this when that happens? Well, better off. Now, I never used to think this way. So kind of a funny little story. when I first got into investing and got into this kind of stuff, I was the guy on the left. That's how I would kind of say it, right? I was what I call group one. I don't need any help. I'll do it myself, all this kind of stuff. And so I went and actually got a policy with my buddy financial advisor, and it was a disaster. And I lost, and I'm going to do a video on this, but I lost six figures, at least six figures because of what he did with a policy. And so that being said, I said, hey, guess what? I want to go learn from the best. I want to be part of the best, right? And so that's when I got hooked up with like Robert Kiyosaki's advisors. One of them was my mentor for infinite banking. That's really when I learned, okay, I want to be part of group two, not that other group, right? And so I used to beat my head against the wall. I don't do that anymore. So that's why obviously why I'm part of the BYOB team here in Money Multiplier, because we are the best, in my opinion, that do this. And that's who I want to be part of. So I always say, for me, it's always group two. Go find those that are doing it, that really focus on it, that are providing that value. And that's who I want to work with. And yes, is that self-serving? Yeah, it is a little bit. But the next step for anybody here who is interested in infinite banking is, let's just you and I hop on a call. There's no obligations, nothing like that. Let's just solve your problems. I'm going to answer your questions, and let's just see how infinite banking is a fit for you and how it can solve your problems. Because here's the thing, if you want different results in life, you've got to do something different. And if you keep doing the same thing over and over, getting the same results, that's the definition of insanity, right? So this is definitely something different for a lot of people. Let's see if it is a fit, because I'm going to be honest with you, it is not a fit for everybody. Mainly about 5% of the population, maybe 10% can do infinite banking. There's a lot of reasons why the majority of the population cannot do infinite banking. But if you are lucky enough, fortunate enough to be one of those 5 or 10%, that's awesome. Take advantage of that, by the way. That's my opinion, is take advantage of that, because you're part of that group that can do this. And then the last slide I kind of like to end on here is the one we started with, which was the quote by Will Rogers. And it maybe has changed a bit for you as we've gone through the presentation, but it says here, the problem in America isn't so much what people don't know, it's what people think they know, like money, right? That just isn't so. So hopefully I've given you some value here around how money works, how we think about money, how you can do things a bit differently to create that life that you truly deserve and want to have through, infinite banking or other kind of things like that. So, all right, thanks everybody. Appreciate all you being on and all the questions and the interaction. So look forward to hopping on a call with some of you here very soon. With that, take care, stay safe, and see you soon.